Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for July 5th of 2025. Well, I hope everyone had a wonderful 4th of July. I know down here in Central Texas, we've had an awful lot of rain and unfortunately some flooding that has come about very suddenly, and prayers go out to all those that are affected by the floods, and hopefully you and the people you care about, if you were in harm's way, that you were able to get to safety. So again, just thinking about all those people that have been affected by the storms. And I will never complain about rain in Central Texas in the middle of summer, but this was a doozy. So again, hope you're all safe. Well, let's jump into it, shall we? We have data that will be coming to us here towards the end of the month on GDP, on economic growth. We also have a lot of data that I think will be showing some impacts of the tariffs, and we've got some charts on that. Here we have real GDP in the amber colors, and we've got in the black. This is actually final sales to private domestic purchasers, and so when we talk about like consumption, we really want to drill down on what matters. And this final sales number here in the black does a really good job of kind of filtering out the noise. And so, where we are in, where we started first quarter, again, we won't get the first reading of second quarter until the end of this month. But first quarter was negative primarily because we had a rash of imports ahead of the expected tariffs. And so when you have imports that far exceed exports, that creates a negative, exacerbates your negative trade balance, which is a drag on GDP. So the big reason why we had a negative economic growth number in the first quarter was because of that. Now, looking at this black line, again, this is not consumption. This is not like GDP per se. This is final sales to private domestic purchasers. So it really is a proxy for demand. And we do see that that has been trailing off. And so this is kind of the prima facie evidence of some slowdown in consumer demand, which has actually been very strong. You can see this black line being very resilient, but we do see this decelerating at a time where we really do expect a pretty strong GDP quarter. And this would be kind of like the offset of this because, we imported a lot and didn't export as much, and now we're probably exporting maybe a little bit more, maybe because the dollar is very weak, but we are importing a lot less because of these tariffs that are now in place that have gone, taken our effective tariff rate from like 2.5% to 10%, which might actually be closer to 15% before it's all said and done. But in any case, expecting a good GDP number, but the takeaway from this slide is that real final sales are decelerating at this juncture. Here we have a quick chart that kind of really capsulizes the housing industry in one overlay here. We've got existing home sales, which have been in been basically flatlining, but now are in a period of like a little bit of deceleration here. So we've got that happening at the time that we've got existing homes for sale that have been moving up, and we've struggled to really gain any significant momentum in new home sales, which we know is a fraction of the volume that we get with existing home sales. But we've got more inventory on the market, and we've got less transactions. We've got more price degradation off the listing price, meaning that people are, we see more adjustments downward on prices because of affordability issues. And the long and short of it is that housing is in a bit of a funk, and it does influence GDP and owner's equivalent rent. That component of it does influence the inflation numbers as well. Here we have capital spending expectations, and this is year to date, and this is actually since April 2nd. So this is a shorter time frame here, and you can see here that consumer discretionary, we had some strong numbers, but after April 2nd, the tariff announcement, you see that that's actually negative. It's negative industrials, and this is an area that you really do want to see capital spending in if you're confident in economic growth. Technology, we know AI has been a contributor to this, as well as communication services. But in both of these cases, here we go again. Since April 2nd, the CapEx numbers are coming down. And really in just about every category here, we're seeing capital spending estimates moving downward after the announcement of tariffs. So soft data versus hard data, you've heard me talk about this a lot over the last several months. So here's your hard data softening, and that trend has continued. So obviously that's very well understood. Soft data are the expectations, and so we had we've had some degradation here, and again, the takeaway from this slide is that hard data is now kind of showing some of that softening. And so I think this comes together perhaps nicely in maybe the September timeframe for the potential for a rate cut from the Fed. This is what they're talking about. That's where like all of the higher probabilities of rate cuts are focusing on is on that September meeting. But we're seeing a lot more kind of dovetailing of hard data that is kind of matching with soft data, even though honestly the soft data has improved somewhat as of late. We've got some traffic from abroad. You've got arrivals in the U.S. from some of these key, Canada, and then you've got European countries, and you can see that these are all negative, anywhere between, call it 8 and 12%. And then we also have the geopolitical risk index, which still remains very high, even though we haven't really been talking as much about Iran as much lately. We certainly haven't been talking about Ukraine as much lately, but that geopolitical risk index is still pretty high. Here we've got kind of labor in a nutshell. You've got the initial claims number, and you can see that this is trending higher. We've had a little fish hook here, but this number is kind of higher in the aggregate. And you can see continuing claims moving higher. So this is all symptomatic of a labor market that is actually still okay, but is showing kind of the natural chinks in the armor that you would expect if you think the economy is kind of like decelerating its rate of growth. And here's personal income growth. You can see that has been higher, moved up higher since the middle of last year, but that's now kind of trending a little bit lower, but still not terribly out of whack with its longer term averages. Employment to population ratio. This is basically a survey, an assessment of the workforce. And again, we're kind of at the pre-pandemic levels, and we've been stable there. So again, relatively healthy there, but obviously something that we want to consider. We want to see people entering the workforce, not leaving it. And then finally here we've got average hourly earnings, and this is broken out by some of the major cohorts here. Retail, hospitality, moving higher. You can see the white collar services, also moving higher, and then overall kind of just remaining flat, maybe slightly down in this case, but again, not terribly unhealthy at all. So we got money supply that had rocketed higher during the pandemic, and then obviously, for the laws of physics, an opposite and equal reaction. Well, that happened here, and so we had a dramatic deceleration in money supply. This is what fueled the inflationary boom here a couple of years ago. This is what's helping to slow it down, although money supply in an economy which is kind of like, still kind of plugging along, it's positive. It's below maybe longer term averages, but it is moving higher. Here we got some deficit and debt numbers. Here's our budget deficit. Again, we're talking about this One Big Beautiful Bill Act, which as of this recording, I'm not sure that the president has actually signed it yet, or maybe he has. Anyway, it's a holiday, so you'll have to give me a minute here. But in any case, it will be signed into law if it hasn't already. And you can see here budget deficits kind of holding in at 6 percent of GDP. Again, I don't think that these are sustainable. We've got the Congressional Budget Office that is, projecting that these are going to perhaps get a little bit, maybe a little bit better before they get a little bit worse. And of course, the estimates now, based on the Senate version of the bill, which seems to be where everything is kind of coalesced to, that's about $3 trillion of additional deficit over 10 years. Federal debt, again, something else that is moving higher, with all these estimates, and GS just obviously stands for Goldman Sachs here, that these projections are all moving higher. And again, this is something that future generations are going to have to deal with. And the rising generation now is Gen Z. They're definitely going to have to wrestle with this as more of the Gen Zers find their way into politics, find their way into government, and they're going to have to wrestle with this. And, I think the baby boomers in Congress are already giving way they're giving way to, Gen Y and kind of that bubble generation as well. But, this is something that's going to be an issue down the road. Richmond Fed manufacturing activity. This is prices paid. And so, we were looking at this from a tariff standpoint, and at least from a survey standpoint, again, soft data, they were looking for a really big bump in prices. This is like on the order of 8 to 9% here. That has come down. This is a good sign. Again, it's still relatively high, so let's not get all excited just yet. Again, we haven't really even seen the impacts of tariffs yet. And just, again, to reset this, the conversation that, before we started, before this year started, we had an effective tariff rate of about 2.5%. Now it's at minimum 10%, moving probably closer to 14, 15%. So this is going to manifest itself in like a lot of the real data that we're going to see in the coming months. So when we talk about, Fed expectations, so here's the Federal Open Market Committee, and, members that offer, their perception of the future. And this is always interesting to look at. It's oftentimes wrong, just to be transparent. But, this is the question asked here is whether they think the risk of the inflation forecast is weighted to the upside versus the downside. And so, you could see here 1920 that the risks were, weighted to the downside. Now we see a very consistent viewpoint here that actually was going down for a while, but then just this year with the tariffs, you can see that that you've got a lot of, basically a lot of sentiment that we're going to see the risk of inflation is to the upside here. Got tariffs. This is the point that I've been making earlier. We had April. Again, 2.5% was where we started the year. Then we had some commentary, from Trump before the Liberation Day announcement, which basically came here. And then these things went way up, went way down. And then we've got Chinese tariffs that are still holding at a higher level. And so right now, arguably you could say that we're already at 15%. I do think a lot of the tariff announcements, and this is important because like next week, right, we're going to be talking about what's happening with tariffs, because on the 8th and the 9th here next week is when the 90-day moratorium on all of these like tariffs is set to expire. And so I do have a strong feeling that there may be some jawboning on the part of Trump, but that ultimately that they will get extended. There's a lot more things that we've got to worry about now. But on the flip side, Trump feels pretty emboldened after having gotten through the OBBBA Act last week. Tariffs impact on the economy. Again, we've got the 25 estimates, and so we can see here as we move through the year that we've got. This is the average tariff rate, which honestly, going back to like essentially 1900. I mean, when we were much more protectionist than we ever were, and then of course the Smoot-Hawley tariffs came into play here, and then that ultimately set us into recession. But then we've been in this secular decline ever since until Trump got elected. And so we can see here as we transition that 12-month recession probability, I think, is worth noting here. As of April 2nd, it was pretty high. Now that has come down. So feeling is that we're not in a recessionary type environment, although there are indicators that might suggest that could be in the future, but that's not the sentiment right now. So core PCE inflation, again, April 2nd, we're looking at 2.5. Inflation was coming down, and then the sentiment here is looking for close to 3%, but not nearly as bad as we thought earlier in the year. So that's a positive. And then obviously GDP growth estimates have been increased as well. So right now, sentiment is much better than it was literally 2 months ago, or I should say 3 months ago. But again, we don't have an all clear signal necessarily. There is a positive probability, and honestly, I would say that a recession probability of anywhere like 30-35% is really not that big, because that ratio usually goes from 25 to 75. And 35 is definitely on the lower end of that. So we've got federal funds. These are just some expectations here. We've got CPI. Again, we know that just to talk about this one first, we know inflation's been going down, but we've got tariffs that are coming into play. So kind of the baseline estimate, it calls for an increase here, and then a general kind of a mitigation over time. But like if we have basically stagflation, then we get something that looks a lot more like this. And if again we do translate into growth, then maybe we have less overall inflation. And the same goes over here for federal funds, that everyone's looking for rate decreases. This is the estimate. So the estimate is calling for probably, in this case, I'd say probably close to almost a percentage point, or about 75 basis points through 2026, it should be noted. And then again, you got the various scenarios here. And then obviously if you got stagnation and stagflation here, then we're going to have a much more aggressive Fed in reducing rates. And therein lies the problem right now, because the Fed cannot figure out just how what the potential inflation rate is going to be at this point, with all of these tariffs kind of hanging out in the wings, and then weighing that against what the potential GDP growth is. And they're in a very big pickle right now. Here we get GDP. I mean, these are very similar, and really they all fit together. So this is actually from Bank of New York's summer research update as far as our 25 outlook, and I think this is a good assessment here. So I mean, you've got GDP that's going down. This is like basically zero, which you would get in a stagflation environment. But if you have a gradual slowdown, and then you get to a point that you trough out here, and then your GDP goes up again. So same deal. This is base case here, and you look at Eurozone, which is important. We know that we have had a lot better response out of European equities than we have domestic equities this year. You can see the calculus looks very similar here, but the trajectory is not nearly, the slope is not nearly as great on the European side, with a similar recovery at some point in GDP looking into 26. So annualized change in real GDP, you can see here we were negative in the first quarter for the reasons I mentioned earlier, and that was really a function of the net trade number. And now that reverses a little bit, but I would say that the economy is not in nearly as bad a shape as would have ever been suggested in this number. But That's not, I'd say some of this is kind of a recapture, but even if you haircut this by, call it about a half to, 3/4 of a percentage point, you're still going to get reasonable consumption. You do have government slowing down, and you do have net trade, which is probably helping you this quarter, but looking out into the horizon, it's probably not going to help you very much, and you're probably going to have consumption slowing down, as we've already kind of discussed today. Contributions to real GDP, we've already kind of talked about this a little bit. First quarter, again, net exports, big drag. Net trade was a big drag. And then government spending too was a drag. Now, looking ahead into the second quarter, which is, admittedly looking into the unknown here, estimates are for maybe a little bit of positive government impact, but on the flip side, you've got inventories which are probably in depleting mode. If you've got tariffs coming, I'm not sure that, how motivated, or if you have tariffs in the pipeline now, how motivated you're going to want to be to carry a lot of extra inventory that you're having to bear additional cost on. So that looks like to be a net drag, but then consumption still is hanging in there. Although, I'd say that probably goes down a little bit. And this becomes a little bit more muted, and then I'd say government spending in the quarters ahead is going to be maybe less of a tailwind and maybe a little bit more of a headwind. Here we have annualized change in core real GDP. So this is an annualized number. Looking at it, again, this is core. So this is like stripping out some of the, some of the things that could be a little bit more volatile in that GDP number, and still strong, but not as strong as it would appear in the all-in number. So the core looks to be still positive, but maybe not as robust as we saw, throwing everything in the kitchen sink into it. Here we have growth components. Now this kind of really breaks it down into the segments. It's very similar to that chart a few slides ago, where you have 1 year ago, what was really contributing. So obviously we were at about 3% growth. Today, looking into trailing 4-quarter growth, I mean, it's still strong. Again, we didn't, we had a pretty strong economy at the end of last year, but not as strong, like including the first quarter. And this data is all as of the first quarter. So you look at consumption, ironically, a little bit stronger. Now, I think that's, as I've said multiple times already, I think that's going to slow. You've got non-residential structures. That's clearly a headwind. Equipment, you've got a lot of AI, data centers involved in here. This is probably going to be, if we have positive surprises in GDP, this is going to be the reason for that, is going to be, that investment. Intellectual property, IP, that's also in decline. Residential structures, we already know, we've looked at that data already, that we've had a decline. And we're looking for a net decline in residential construction benefit into the economy. Federal spending has been stronger last 4 quarters, but again, I do think, again, we're talking about DOGE, we're talking about the federal government. Do think that that's probably going to be less beneficial, as is the state and local spending, which was fairly strong over the last quarter, or excuse me, over the last year. I have a couple charts here that I thought were pretty interesting to mention. We talk a lot about energy independence, and you can see net imports of crude and petroleum products. And, I mean, the advent of the shale revolution here in a couple of decades ago, and you can see that number of net imports has actually gone negative. So, we are essentially a net exporter, which we've talked about a lot, but again, this chart from Alpine Macro really just kind of capsulizes that whole revolution in one chart here. So, and just the dependence on oil as a function of global economic growth. You can see the changes here. And here's real GDP. and you can see that oil production has really not kept pace with that. So obviously we're finding other alternative energy sources, and we're making things that are a lot more energy efficient, so on and so forth. And you can see oil production to real GDP continues to move lower. And this is not something that, unless you saw this data, that you would intuitively expect. But, this is a real interesting trend, in my opinion. Some more charts here from Alpine Macro. Talked a little bit about these tariffs and the average tariff rate here, and consumption expenditures. Maybe tailing down a little bit here. But again, we really haven't seen any big impact from tariffs yet. I do think it's coming, because you just don't have this kind of dislocation without having some greater impact on consumption. And you can see how we've already seen how it's been a tailwind in economic growth. And I just think that that's where we slow down in the coming quarters, because people are going to absorb the one-time inflation, from the tariff adjustments, and then they're just going to modify their behavior and their spending after that. And profit margins, I think we've been spoiled, because we've had corporate profit margins that have actually been very good. And again, in this environment, if you're going to get consumers to pay the entire bill of all the inflated costs, and that's one thing, you could probably hold margins, but I don't think that's going to be the case. It's a competitive environment, and I just think that profit margins, have room to slide a little bit on the downside. Here we have geopolitical risk again. We talked about that a few slides ago. Again, just looking higher clearly than what we've seen. This is the line of best fit going back to 2010, and you can see, where we are. A couple slides here on Social Security. So, and there's more conversation this past week about when the proverbial trust fund is going to run out. And here's our dedicated revenue source. Again, we've got a demographic issue. We don't have as many workers in the workforce that are contributing to Social Security as we had, several decades ago. And so here's our dedicated revenues, but here's the scheduled benefits, because we have an aging population. And so this is hypothetically speaking, from the view of First Trust, what would have to happen in 2034 for us to not exhaust our trust fund. And we essentially have to have a 19% benefit cut, which you can imagine in the aggregate would be a big blow to a lot of people. This chart kind of shows the demographic issue that we face right now. That basically we had a number of covered workers per beneficiary. 1945 after the war was 41.9, and even as recently as call it the beginning of this century, just 25 years ago, about 3.3, and now we're down to 2.1. So this is the problem. You just don't have as many workers that are contributing for every beneficiary. And so, just so this is no jargon, chart pack here this week, but just to be clear that this OASDI stands for Old Age Survivors and Disability Insurance, which is actually the official name for the Social Security program. Here we have the basically the Social Security Trust Fund. This is what this represents here. Again, as I mentioned, Old Age Survivors and Disability Insurance Trust Funds. That's the Social Security technical name for it. So you can see the growth of that, and this is kind of basically charting out where where those benefits, or where that trust fund exhausts itself, and where, in the absence of other, advanced legislation or whatever, where you would have to have that benefits cut to not be insolvent. So a couple other charts back on Alpine Macro. You've got the dollar index, which we know has been weak, but again, not out of, significantly out of channel here. But it clearly been weak, and that's very much felt within the economy. So here we've got money supply, which I told you had dropped precipitously after going straight up for a while. Money supply is now positive, and then we've got nominal GDP, which at this juncture is moving lower, but still positive. CEO confidence moving lower, and consumer confidence that had really cratered is still subdued, but it's not as bad as it was. PCE inflation, this is basically the Fed's preferred method of, or preferred definition of inflation rather, and you can see that this is still moving down, and again, hasn't seen the impact of the tariffs yet, but likely to manifest itself a little bit in the coming quarter. Businesses expected pass-through. This goes directly to the margin question that we were talking about several slides ago. And you've got basically, the input cost increase. I mean, there is some consensus that they're going to be able to put through, but it's not going to be everything, and it's not going to be all companies, and there's going to be competitive pressures to accept lower margins to be able to, maintain market share. Here we have operating margins on the S&P 500. Again, just as I have kind of said, this is, Bloomberg bottom-up consensus estimates looking at the full year. So even though we're already past June 2025, this is the estimate for margins looking out into the full year of 2025, and you can see that they've come down quite a bit following the, call it the tariff tantrum. Trade uncertainty did peak in April. You can see that here. This is a trade policy uncertainty index. This is inverted and with the right-hand scale, which moves higher as you go lower. So obviously, a very cathartic event here. But then, you can see, interestingly enough, and this is what I find very fascinating in this chart, is that if you take the inverse of trade policy uncertainty and map it against the S&P 500, it explains perfectly why the S&P has continued to move higher. Because even though trade policy uncertainty is elevated and maybe jockeyed around a little bit the last month or so, it's still in an upward trajectory. And you can see, this relationship is not perfect, but it's certainly been very strong here since April. Now we have expected earnings per share growth. And you can see really the only place where we're not expecting growth is Japan. So you think about, all right, well, what's eventually going to happen in the economy and what the central banks are going to have to do in response to that. I mean, you really see, Europe, looking a little bit better. U.S. Large caps a little bit more subdued here, and then China, certainly from its historical rate, looking a lot lower, but still positive. So again, you've got a very interesting dynamic where you have countries, regions that are actually looking, they're still looking okay, even though they're decelerating. But then you've got Japan that is likely to be negative for a while. Valuations are important because we've retraced some of those losses, and you can see here, this is the cyclically adjusted PE ratio, and we're about 38 on that right now. We look at corporate profits per worker. We just haven't seen any reversion in this. This used to oscillate quite a bit, and we've seen these, meteoric rises in this profits per worker. So again, you've got technology, you've got AI more lately, but no sign of a recession here, although valuations obviously getting a little frothy on the financial market side. Volatility, as we see here, has gone down, and so I'm not going to worry too much about explaining put call skew here, but just really the implied volatility over 1 month is the important read through. So look at that blue line here, and again, that moves lower. So we really haven't had a lot of volatility. It spiked around the tariff tantrum, which is actually right here, but it spiked in advance of that, and it's been elevated, but continues to move lower here lately. We've got valuations, as I said. This is the current valuation, is that dot, and then basically, here's the 20-year median is that line, and then what we have here is kind of that range of the 25th to 75th percentile range. But again, I'd say almost look at that 20-year median. NASDAQ, well over that. Russell 2000, much more in check, but still in the aggregate 24 times. Puts it at the high end of its 20-year range. And then S&P 500, you can see, here, that's 16 times here is the average. We're 22, probably a little bit more than that. And as we've talked about often, actually, over the last year to 2 years now with the Mag 7, is that if you look at the equal weight, we're not visibly stretched in valuation, but the S&P 500 is dominated by a handful of very, very large companies that happen to reside in the technology space, and that makes this a little more difficult to stomach. But if you look at everything on an equal weighted basis, it's much more in line, as is the mid-cap 400. This is a statistical dot plot, basically going back to, data goes all the way back to 1881, if you can imagine. But this is an annualized 10-year return versus the starting ratio. Like if we say, all right, we're going to take today, the cyclically adjusted PE ratio is about 37.8. And so this shows you that based on that PE ratio, what your 10-year annualized return is likely to be. And so here's that little dotted line, is that line of best fit. And so you see a clustering of things over here. So, most of the time you see, CAPE ratios that are probably no better than, honestly about 25, maybe 28 here, because most of your observations are in this cluster right here. But, if you're, basically looking at, 37, 38 times, then your annualized return is going to be probably, 5% or less, based on this line of less fit. So, again, this has some variability to it. It's not suggesting that we're going to have like basically 1% growth. It's just saying that growth, because the multiples are higher now, is apt to not be as strong as we see in some of these areas where we start off with a lower PE ratio. S&P 500 buybacks have been notably strong this year. Very interesting to see that, because after this trend looked like it was developing, and it's basically reversed, which is good. I mean, we favor dividend-paying stocks and buybacks. This is those are two primary ways in which companies get capital back in the hands of shareholders, and this, in some respects, may tell you, all right, fine, margins are good, so there's the ample cash flow that can be used to buy back stock. The other flip side, like the kind of the more negative connotation, would be that you don't have internal capital spending projects to spend on. And we've already seen today where CapEx has gone down. But if you don't have projects, or you're not wanting to spend on projects because you don't want to add capacity at a time that's maybe economically uncertain with tariffs, et cetera, then you might choose to take that free cash flow and put it back into buybacks. And I think there's actually some of that here, but profits are still high, so there's some of that there as well. So, but it's very interesting, because you go back to 2021, and we had high buybacks then. Obviously you didn't have it in the pandemic, but it started to reaccelerate when we opened businesses. But you can see where we were in the latter part of the last decade. I mean, we've set all new trends here. So it really the same kind of goes for dividends as well. This chart looks very similar. So free cash flow strong enough to support it. That's all the charts we have this week. Hope you've enjoyed the chart pack. Again, our hearts and thoughts go out to all those impacted by the Central Texas floods. Aside from that, I hope you all have a great week, and we'll talk to you again soon. Thanks.